Hey, how's it going, everyone? Zachary Jensen here, managing partner of TaxWise Financial Services, where we're helping empower small business owners by minimizing their tax savings and helping them grow with confidence. Today, I wanted to go over a more serious topic that happened to me personally. It's how I lost personally over $1 million in pursuing tax strategies that we now do not refer to our clients. This was luckily before the days of TaxWise, but I wanted to go over this as a lesson for all future clients pursuing these various asset classes, as well as folks that are interested in these asset classes or follow this general philosophy that they're trying to reduce their taxable income and they'll invest in whatever it takes to do so. I like to caution those folks because, as I just mentioned, I've lost quite a bit of money doing that. So, losing over $1 million in personal funds. I did this through oil and gas investments, ATM ventures, real estate syndications. And it was not just a financial blow, but a very painful lesson in the importance of due diligence and risk assessment. I entered these investments looking for a way to maximize my tax savings while growing my wealth. And a common goal for high income earners is to do this, as we just said. So, the promise of significant tax savings really clouded my judgment back then, and I overlooked critical details about the risks involved. And this video isn't just about my loss, right? It's a cautionary tale for those seeking those quick tax savings without fully understanding the underlying assets. So, the first major loss actually came from an oil and gas deal where I lost over $450,000. This investment was pitched as a way to capitalize on the unique benefits of oil and gas investing, particularly the intangible drilling costs, right, and the bonus depreciation at the time. These deductions allowed investors to write off large portions of their investment up front, significantly reducing their W-2 taxable income. In addition to that, the depletion deductions were promised, which enabled me to offset future income from the oil wells. On paper, this deal seemed like an ideal way to save on taxes while generating passive income. However, the entire operation actually ended up being fraudulent. The sponsors were doing little to no due diligence on the project, and the promised wells didn't exist either and were unproductive. So my biggest mistake here was trusting sponsors and the claims they made without verifying the legitimacy of their operation, right? I was not an oil and gas expert, and I put my faith in other experts. Obviously, it didn't work out. So the lesson here is no tax benefit is worth it if the investment itself is fundamentally flawed, right? We always want to verify sponsors' credentials and the project's feasibility. We always want to look into the actual legitimacy of the project, get financials, get third-party verifications, do whatever it takes to make us understand from start to finish how the business makes money, because if we don't understand that, then we shouldn't invest, plain and simple. The second significant loss came from the ATM machines investments, which also turned out to be quite an issue. The venture was sold as a way to generate consistent cash flow while benefiting from depreciation deductions. Similar to real estate, ATM machines qualify as tangible property, meaning the cost of the machines could be depreciated over time and reducing taxable income. The sponsors even claimed that bonus depreciation provisions under the Tax Cuts and Jobs Act would allow me to deduct nearly the full cost of the machines in the first year, making the investment extremely attractive from a tax perspective and from a passive income perspective. What I didn't realize was that the underlying business model was unsustainable and the sponsors were actually mismanaging funds. So once again, I relied on the judgment of the wealthy, and it seemed like they were very, very experienced. Clearly, they were not. They were just relying on someone they thought was smarter than them as well. So this lesson taught me a critical lesson that tax benefits should enhance a sound investment, not justify a bad one. So we never want to invest just for tax benefits. I did all these investments in the same year, so had a good year, and then I lost all the money. So definitely, please learn from me here. The third lesson came from real estate syndications. This experience highlighted a completely different kind of risk. So these deals were pitched in 2022 when interest rates were historically low, making them seem like a safe and lucrative opportunity. But many syndicators in the real estate world rely on something called bridge debt, which is short-term financing often used to fund value-add projects. And the sponsors claimed that the projects would generate strong cash flow and that I would benefit from depreciation deductions that are inherent to real estate. Though the strategies like cost segregation and bonus depreciation didn't necessarily apply here because I was a passive investor, they still projected significant losses that could offset W-2 income, which obviously was not true, and saving me tens of thousands of dollars annually. However, when interest rates began to rise sharply, The costs of refinancing the short term debt skyrocketed, wiping out all the cash flow of the real estate. Some of the deals I was in luckily sold at a loss, but others were foreclosed and handed back to the bank. And my failure here was just not understanding the risks associated with levered real estate investments, right? And we always talk about real estate being such a safe investment, but if you don't have the right capital structure, you can add a lot of risk to them unnecessarily. So this is how rising interest rates could have jeopardized the viability of future projects, and how they did for mine as well. So the key takeaway here is always dig into the capital structure of a syndication, especially the debt being used, and assess how market changes could impact the investment. A lot of real estate syndicators wipe this under the rug. They say that, oh, the real estate's so safe, blah, blah, blah. They never tell you about the risk because they're trying to get your money. So you got to verify the character of your syndicator and that they're doing a deal that isn't risky. So always verify your capital structure. Now, across all these three investments, the pursuit of tax benefits blinded me to the importance of assessing the underlying risks and fundamentals of the deals. The tax strategies themselves, such as the oil and gas, the ATM, the cost segregation on real estate, the tax strategies themselves, such as the depletion deductions on oil and gas, depreciation on ATM machines, and cost segregation on real estate, are legitimate strategies and can be incredibly powerful. I'm not saying I'm against them. I'm just saying these are best utilized when the investment is sound and well vetted first. We want to make sure that the investment is great and it is rock solid before sprinkling on tax savings as a cherry on top. I failed to do my necessary due diligence back then to ensure that the opportunities were legitimate and sustainable, and I relied too heavily on the reputations of others and the opinions of others. And I assumed that wealthy, sophisticated investors were investing in these deals, so the deals must be safe. But this was a costly mistake that reinforced the importance of taking personal responsibility for every investment decision and having extreme ownership over it. So the overarching lesson here is that no matter what, no tax saving strategy should ever replace thoughtful due diligence, thorough due diligence and risk assessment. While the potential to save on tax can be incredibly appealing, it should never be the sole reason that you make an investment. Instead, tax benefits should act as a bonus that complement a fundamentally strong investment. If an opportunity sounds too good to be true, probably is. If you don't really know how it fundamentally works, take a step back and take the time to investigate. Whether it's oil and gas, real estate syndications, or any other tax advantaged investment, the responsibility to protect your capital ultimately lies with you. So that's why here at TaxWise, we actually don't recommend any specific investment providers. We're very, very careful about who we tell people to look into for investing, because we're never going to recommend anyone in particular, right? We always want to, if you're going to take the training wheels off and look into alternative assets, that we warn you, we caution you, we know how to do the tax savings, we're aware of all this stuff. There are great times when this applies, right? As I mentioned earlier, there's really, really powerful tax savings to be had in all of these assets. You just got to make sure that you're either doing it with the right sponsor or doing it yourself and you're in control and you understand it. So yeah, that's kind of my sad story, but very true. And don't worry, I bounced back. No one went hungry. We were able to get back from that. But I don't want this happening to you. So if you have any questions about these tax strategies or any sort of questions on specific investments you're looking at, give us a shout. Our contact info is in the description below. I look forward to hearing from you soon. Thanks so much for watching.